Welcome to AHA Math and Science. Well, in today's video, we like to discuss a strategy for growing investment effectively, and really a strategy that you can actually use to beat the broad market, the index fund. So, one of the sort of easy way to kind of grow your investment is just put all your money into an index fund, and that's kind of the passive investing, and you will get a return pretty much comparable to the broad market. So in this video, we like to actually discuss whether there's another strategy that can be actually implemented, with relative ease and grow your investment much more effectively than the broad market. So let's talk about that. So this is just a hypothetical situation. Let's say that someone starts with $10,000 on January 1st, 1983, and would be the appropriate decision to take to grow this $10,000, and then hopefully become maybe multiple $1 million as of today. So, and you want to put the money into the stock market, and you don't want to put the money into the index fund because you want to actually beat the index fund. So this really not about actually trading stocks. So this is not the strategy that can be done with ease. So we want to think about long-term investment that actually you can use a strategy and grow the investment. So the work really has to be done at really upfront. And once you actually done the homework, done the due diligence, and actually the efforts afterwards will be, it will be much easier. So here it's really kind of boils down to pick the companies with the great potential. So I know we clearly, we don't actually know, which company is going to be kind of like have the great potential down the road. Now, when you kind of look, from hindsight, obviously, like which company is great. But let's say that we don't have a great knowledge about which specific company would be great. So we're going to pick a few companies. So let's divide this $10,000 into 5 baskets. And the first company we look at, the index, okay, Alcoa, which is a company make aluminum. If you think about, aluminum used in everyday life, from like aluminum foil to actually building an automobile, that looks like a great company. If you are kind of thinking about, the fundamentals, the basics, that's a basic material company. So let's put $2,000 into this company. A very sound investment, at that time. And the next company we look at is Apple. That's a new company at that time. But they're making this electronic, gadgets, computers. Seems interesting. It could, have a lot of potential. So let's put $2,000 into this company. The next one we say, like, financial is always a kind of a piece of the economy. So you look around, we don't want to put the money into a big bank, but Bank of New York Mellon seems to be a decent, target. So let's put $2,000 into that company. The company was already there for quite some time, so it's doing business well. And the next one we look at is another new company called Home Depot. So at the time, it's selling products for home improvement, and that can be used, pretty much, by everyone. And it's really kind of also related to another way of investing in real estate. So that seems like a reasonable investment. Let's put $2,000 into that company. And the last one is a giant technology company called IBM. And everybody already knows that company at that time. It's been around for quite some time. And it's doing great business, investing in new technology. So let's put $2,000. So when you look at this picture, when you have this $10,000 and you want to put it into 5 companies, these are actually pretty decent choices if you think about and if you do some homework. So let's, from this hypothetical portfolio, see what would be the amount of current investment. Alcoa is a great company. You can see since 1983, when you invest money, it was kind of growing nicely. But then it kind of gave back all the appreciation during the 1990-1991 recession. But after that, the next 10 years is great. It has explosive growth, but then not so much from the beginning of the century to the present time. It's growing, but you see that it was down, it was down during the great, recession, and it just kind of barely kind of not above, these levels. So not really impressive. So if you fit the data, use regression analysis, this is, by the way, this is a log scale, we find the R-squared value is 0.37. So it's not really a great fit, meaning that Alcoa is not really kind of like following the compounding return formula, over the past 40 years. But nevertheless, we fit it, and we find the average annual return is only 4.2%, which is even below the broad market. So a investment that seems to be so reasonable, basically in 1983, it turns out it's a great investment. Next company we look at is Apple. So you can see that even though nowadays everybody knows Apple and it's a giant company, it has a market value above $2 trillion. But actually, when you put the money in 1983, for nearly 20 years, it's going nowhere. From 1983 to about 2003, it's going nowhere. It had a few sort of nice periods, but then it gave back all the return, and then another nice period, then give back all the return. So it's not really doing that great for the first 20 years. So, but then it had explosive growth from 2003 to the present time. And that is the kind of mark the kind of the a period of very fast growth for the company. But it requires a lot of patience. If you kind of give up during any of this period, then you have not really kind of enjoyed the explosive growth. So it's really kind of hard to see that a company always does well for like multiple decades. There's always ups and downs. And the R-square is 0.88 with a very impressive average annual return of 21% for Apple. So this is one of the sort of like great investment in these 5 picks. And the next one is Bank of New York Mellon. You can see that since the initial investment, it went up nicely, but then give back all the return, in the 1990, 1991 downturn. It's a recession actually, and then kind of had an explosive growth in the next 10 years until basically the burst of .com, and then you have a recession. And then since then, it's growing, but it's growing much modestly. It's just kind of growing very slowly. You can see from the chart here. And the log scale, they kind of give you a sense exactly how the company is doing. And the R-square is 0.84. So it is a nice fit, but it's not like a super nice fit. And the average annual return is 11.2. It beats the broad market. For the SP 500, the average annual return is about 8.2%. So it still beats the broad market, but it's just like 3% above the broad market. And the next one we look at is Home Depot. So the first few years, it's going nowhere, but then it had a very nice sort of explosive growth from about 1986 to all the way to like 2000. And then from 2000 to 2010-ish, you can see it's going nowhere. Actually, it was in a downturn. And then after that, you had another sort of very decent, growth period until now. So even for a company like Home Depot, you can see like, overall growth is very nice, but still you have this almost like 10 years of lost time. It's going nowhere, or it's in a downturn. Really, even for a great company, if you are really kind of like confident about its potential, still needs a lot of sort of determination in terms of patience. And R-square is 0.898 with an average annual return of 18.6%. It's comparable to Apple, but note that if you actually put the money here, it's below the trend. The trend is this red line. So actually your return from 1983 to present time is even better than the 18.6%. So the last one is IBM. It's a technology giant. And you can see the first few years it's growing nicely, but then it had a really bad downturn for almost like 7 years, from 1987 all the way to like 1994. And so after that, it actually had an explosive growth all the way until like the burst of .com. And then from 2000 up to like the present time, it's growing, but it's not impressive at all. It's really just kind of mediocre, growth. So If you look at the regression analysis, the R-square is 0.86, and the average annual return is 8.2%, which is really pretty much exactly the same as the average annual return for the broad market, the S&P 500. So you can see that even for a technology giant, which is a well-established company in the early 80s, it's already kind of a very mature company. Everybody knows that, but you can see the return. It was just similar to the broad market. So this give you a sense that actually, when you actually do your homework and research which company to pick, requires a lot of due diligence. You have to kind of look out to the future, to the potential. So now, as our close of Friday, April 21st, where are the investment now? So for Alcoa, the initial $2,000 is become $18,000, and for Apple, the initial $2,000 is become $3.2 million. Wow! And the Bank of New York Mellon is about $146,000, and Home Depot is a whopping $3.8 million. That initial $2,000 investment. After 40 years of compounding, you can see the powerful compounding return. And IBM is really only like $31,000. So you can see the most contribution is coming from these two companies if you have this basket of five stocks. And the total investment is now about $7.2 million. Very impressive. And for an average annual return of 80%, you actually just kind of beat Warren Buffett. 18% for 40 years. That's really impressive. So you can see that the power of actually just have one or two companies in your basket, as long as it's a multiple back, like 10 times, 100 times, of 1,000 times back, that really kind of outperforms the broad market. For the broad market is only 8%, 8.2% annual return. This is 18%. You may wonder, like, maybe this Apple company, I'm not that lucky to pick that one. So let's just imagine that you pick some companies, blah blah, and then the company went bankrupt, it becomes zero, and your second company is another blah blah, also becomes zero. A third blah blah also becomes zero. A fourth blah blah also becomes zero. The only company that is left, and is you hold on to Home Depot for 40 years, and that still give you $3.8 million. So your initial investment of $10,000 becomes $3.8 million, and for average annual return of 16%, you are still really a great investor because you have beaten the broad market by almost like 8%, more than 8%, right? So from 8.2% to 16%, it's really like 8% difference. You are still a great investment. You are still at the same level as Warren Buffett. Now you could also ask, what if I'm not that good, I can pick like 5 stocks and then one of them is Home Depot. Let's say that you have done your homework and you have been really kind of diligent, and analyzed, all these companies, and you picked 10 companies because you're not that sure, if one of the companies were great. So you pick 10 of these companies. Let's just imagine 9 of these companies went bankrupt. Just all become zero. And the only company you head on is Home Depot. So in each of these piles, you put in $1,000 because you have a total of $10,000. And that $1,000 of the compounding return give you $1.9 million. So your total investment is $1.9 million, and still you have an average annual return of 14%. You are actually still at the same level as Warren Buffett. You got an average annual return of 14% for 40 years. That's still hugely impressive. So what's the take-home message? Really, you want to actually do your homework, do your due diligence, and find out, which company has a great potential. You cannot be sure like every company you pick is going to be a great company. But if you have really done your homework, if you pick like 5 to 10 stocks, 5 to 10 companies, as long as one of them is going to be a multiple back, like 100 times back, 1,000 times back after 20, 30, 40 years, and your return is going to be really kind of grow in a compounding formula, and in the end, your return is going to be much better than the passive investing of just putting in the index fund. you're going to beat the index fund, and you're going to become one of the great investors. So really, this is the take-home message. You don't want to diversify your portfolio too much. If you have like 100 companies, and on one of them is multiple bag, still your return is going to be basically low because the averaging effect. So you want to actually really kind of narrow down to 5 to 10 companies and do your homework. And doesn't matter whether the 9 other companies become zero or not, because in the end, it's really this most successful, the one that actually give you 100 times return, 1,000 times return, that's going to lift your portfolio to a return that is going to be much better than the broad market. So I hope you have found this video interesting and enjoy this video. Really your support means a lot to this channel. So I appreciate every view that and also your comment. And so please do not forget to click the like button and also to subscribe to our channel. And thank you very much for watching.